Welcome to Morphic Labs, and today I'm going to be continuing our discussion on market data aggregation. If you don't know what market data aggregation is, I suggest you go look at my previous video on what you see is what you trade. Now, as usual, I'm going to be referencing my market microstructure and trading systems course. If you're interested in going through it yourself, it's basically free. The link's in the description. Hit the subscribe button if you want to keep up with more content like this, and let's get into it. So on my previous video, we left off talking about volume-based aggregation. We already covered time-based OHLCV aggregation. We already covered tick-based aggregation. Now today we're going to be covering volume-based aggregation. But not just that, I have something special too, which is a little glimpse of my advanced market aggregation course. Now, if you're interested in getting your hands on this course, tap the link to my Discord and talk to me, and I'll qualify you to see if you are eligible to access the advanced market aggregation course. But we are going to essentially be looking at what's called an adaptive price aggregation. Now, I'm going to start with this one before I go back to the volume-based aggregation. Now, what is an adaptive price aggregation? Adaptive price aggregation dynamically adjusts parameters based on market conditions, providing more responsive analysis during volatile periods while maintaining stability during quiet markets. Now, what is the formal description of an adaptive price bar? Adaptive price bars automatically adjust their construction parameters based on realized volatility or other market condition metrics. The formulas: dynamic bulk size, B sub T equals alpha, which is our scaling factor, times ATR sub period times the square root of the standard deviation of the current divided by the standard deviation of the reference, where alpha equals the scaling factor, like typically between 0.5 and 2. ATR is the average true range over a reference period. This is the current realized volatility, which is the standard deviation of the current volatility. Standard deviation of the reference. When to use: markets with varying volatility regimes, multi-asset strategies with different characteristics, adaptive trend following systems, risk-adjusted position sizing, regime switching models. Now, what are the advantages and disadvantages of such an aggregation? The advantages are self-adjusting to market conditions, consistent signal quality across regimes, reduces parameter optimization needs, better risk-adjusted performance, more robust across different instruments. The disadvantage: more complex implementation, additional computational overhead, adaptation lag during rapid regime changes, requires careful calibration, may overfit to recent conditions. Now, let's look at an adaptive price bar on real actual market data. So here I have, as usual, my GBP USD 1 minute tick data. And now what I'm going to do is I'm going to aggregate this using the adaptive price formal description, which I already wrote up the code at the top. I'm not going to get into it, maybe one day in the future. I hope you're enjoying the silence. Okay, now we have our here's our plot. At the top we have GBP USD raw 1 minute tick data. And At the bottom, we have our adaptive price bar aggregation, where alpha equals 1.5, which is our scaling factor. Now, when you look at the adaptive GBP USD price and the GBP USD actual price, these two look almost identical, if not the same, right? But there's a subtlety here that obviously you cannot pick up just by looking at the plot. Maybe you can see the subtle differences where the adaptive price aggregation essentially is processing the tick data in its own unique way. But to truly understand why these are not the same, let me show you something. Right, we're going to take the average of the GBP USD raw data, and we're going to take the average of our adaptive price. Now, as you can see, the two averages are not the same, right? The average of the GBP USD 1 minute data is not the average of the adaptive price bar with a alpha equals 1.5. Of course, as you change alpha, the average also changes. So essentially, the statistical properties of the GBP USD raw data and the adaptive price bar are not the same. Now, what's the difference between these? Now, the distance between the averages is 0.00017194705012246736. Now, of course, as I adjust alpha, the statistical properties change. Now, there was adaptive price bars. Let's get into where we left off on the previous video, volume bars. If you don't remember or haven't watched the video about what you see is what you trade, I recommend going back at that, but I'm going to touch on this right now. Volume bars close on a predetermined quantity of shares contract has traded. The formula, each bar closes when cumulative volume reaches V sub target. The sum of V sub I, as I indexes from I to some arbitrary value, is greater than or equal than target, or is greater than or equal than the volume target. Partial trades at boundary may be split or carried over based on implementation. When to use volume bars. Strategies based on volume confirmation, analyzing price impact of large orders, market making with inventory constraints, comparing activity across instruments with different liquidity. Advantages directly tied to market participation, more stable statistical properties across time. Better for analyzing volume price relationships, reduces noise from low activity periods. The disadvantages: target volume selection is arbitrary, may combine trades from different times, difficult for calendar-based analysis. Corporate actions require adjustment. Now, let's take a look at what a volume-based aggregation might look like. Here's the code. I'm not gonna touch on it, but let's check it out. Now, remember, when it comes to volume-based aggregation, our independent variable is this, the volume target. Now, the volume target can be changed accordingly. So right now, I'm going to pick a large volume target just for the sake of it, and then I'm gonna reduce the number. So I'm gonna pick a volume target of 100, right? And I'm gonna run this again. Now, here is our volume bar aggregation. As you can see on the top, we have raw GBP USD price data. And on the bottom, we have volume bar aggregation where V sub target equals 100, right? So our volume target is 100. So every single bar has a volume of about 100, right? And as you can see, it has this beautiful structure to it. But what happens when you change 100 to say 10? You change it to 10, right? Now, as you can see, it looks like it's gotten finer, right? Because we have smaller volume targets. So as you can see, it looks very, very dynamic, very chaotic. But let's decrease the volume target even more. Let's say we have a volume target of 3. As you can see, it's even more finer than the volume target of 10, right? Just for the sake of it, I'm going to change the volume target to 1, okay? And it's even more finer. I don't know if you can see the difference, but I'm going to increase the volume target just to make it a little bit more obvious. I mean, the subtleties are observable if you pay attention. Wait, I think something is wrong. Let me try this again. Yes, here it is. So as you can see, when we increased the volume target, as you can see, the distribution of the bars are more dispersed, right? There's more distance between them. And also there's more structure that can be exploited for some strategy that one can make. Before I move on, I just want to test something to see if I've been doing this right. Okay, okay, okay. So the V target here is 10. As you can see, it's much more finer, much more dynamic. But once we say take V to 10,000, we have this, and it's much more cleaner, right? And you can see why this will be useful for essentially looking at more stable statistical properties across time, for strategies based on volume confirmation, analyzing price impact of large orders, comparing activity across instruments with different liquidity. Another advantage here is reduces noise from low activity periods, better for analyzing volume price relationships. I mean, the plot just speaks for itself. As you can see, the volume bar aggregation is, like I said, fairly clean, fairly clean. But that's about it for today's aggregation. On the next video, we're going to be talking about dollar-based aggregation. And I'm going to give you a little bit of a sneak peek into my advanced market aggregation course. I'm going to be walking you through information theoretic aggregations, which is fucking cool. Very cool. If you're interested in going through advanced market aggregation course, tap the link in my Discord and I'll walk you through some qualifications to check if you're eligible for this course. But if you're not eligible for this course, don't worry. Here's a course you can get for free. Market Microstructure and Trading Systems. It's free. Links in the description. Hit the subscribe button if you want to keep up with more content like this. And I am out.